Hello and welcome to Markets Tomorrow. I'm Neeraj Shah. A day before the budget, and well, it was a bit of a thumbs up for the market. If that is anything to go by, then probably expecting a resoundingly good budget for the market, but that's not usually the way the script turns out, so we'll wait and watch what happens really. 35 points up for the Nifty. So good going for the index today. Before we talk about the market internals, quickly tell you the voices that you will see on the show today. You will hear of course, Rashesh Shah, Chairman and CEO of Edelweiss Financial Services, K.R. Bharat, MD of Advent Advisors, and Sandeep Wagle, founder and MD of Aptar Technical Advisory Services, to give us chart checks as well. Gentlemen, thanks so much all of you for joining in. Rashesh, I'll start off with you first. It's a bit of a subdued market, and we haven't really seen such a subdued market a day before the budget with the kind of cuts that the mid-cap space has taken to. What's happening really to the market?
Yeah, I think it always happens, especially I think India is at a very critical point where there are quite a few confusing signals. I think the key thing that we don't understand as much is, in the last week, global liquidity, I think issues have started coming on. I think risk off is starting to emerge globally also. So I think the impact on that is also being counted, and it's getting commingled with the union budget, around the corner. And as you said, expectations in the last couple of months have gone up a lot. Sentiment has been very good. Liquidity globally had also improved in the last couple of months. So I think it's all coming to a head, and the market, quite a few investors and markets are saying we'll just wait and watch for another day and see what comes out.
Bharat, what did you make of what Raghuram Rajan's economic survey said today? There were a few positives, maybe a couple of blips as well. But what did you make of the economic survey?
Well, I think, you have some very, very sensible people there now, and the economic survey said pretty much what was to be said. But, if I look back over the last 30 years, that I've been following the budget since I started my career, the linkage between what the economic survey says and what is actually presented in the budget is pretty dubious. But a couple of takeaways from the economic survey. One is a fairly aggressive growth forecast for next year. From a reality of where we are today, which is 5%, according to government numbers, the reality could be a tad lower, to a forecast, an average forecast, I believe, around 6.5%, and that's a fairly aggressive increase is what the government is forecasting. And so in order to achieve that, I think, we'll have to wait and see what they've got in store for us tomorrow, but it'll have to be a pretty remarkable package, is what I can say. But what this points to is the fact that if you're going to be assuming a GDP growth rate of 6.5%, then I think the assumption in terms of your revenues is probably going to be more optimistic than is warranted, and that sort of tells me how the finance minister is probably going to achieve his 4.8% fiscal deficit target.
Bharat, what about the kind of mood that the mid-cap end of the market seems to be in? I mean, sure enough, some of the stocks like Jet get rewarded for potential deal or otherwise, but just the carnage that we're seeing in some of these slightly more sketchy names and the volumes at which these stocks are falling.
We were speaking about liquidity a while ago, and I think, the entire sort of market move over the last few months has been liquidity driven and not fundamental driven. And therefore, when you speak of carnage, clearly when you're talking about stocks which aren't liquid enough, if there is even a hint of a problem, as I think we saw a couple of days ago with people sort of dumping stock, you are going to see the kind of carnage that you saw. And this is certainly not a market where you should be investing in illiquid stocks, and I guess when you say illiquid, pretty much the entire gamut of small cap and mid cap stocks come in there. I'm a great believer in the mid cap story, have been for a long time, but when the market is moving purely on liquidity factors and not on fundamental factors, in an environment where inflation is on the up and GDP growth rates are on the down, then illiquid stocks, or in other words mid cap and small cap stocks, are typically areas one should stay away from.
Sandeep, what do the charts suggest? Let's talk about the large caps first. We'll talk about mid caps in a bit, but the kind of fall that Ranbaxy showed post the numbers, 4% down today as well, and some of the IT names took a bit of a backseat after a strong run up.
Well, I would, Neeraj, comment on the Nifty per se first. I think Nifty has bounced back from an extreme sold zones, and I think Nifty is still on the way down. I see a 5600, 5650 level in the Nifty. Probably, yes, tomorrow we may go up in anticipation 40, 50 points, and the range broadly is 5650, 5850, 5860. I mean, I don't want to talk of individual stocks will move their way. Most of the stocks have moved up, and probably they can see some more upside. But at higher levels, when you are talking of 150 point downside on the Nifty, even the front lines will not move up one way, leave aside a few exceptions. So I am not that bullish unless something exceptionally positive comes in the budget. I think the markets itself are undecided, and no point in reading into it. I think today's move was a bounce back, which can extend, as I said, to another 40-50 points, nothing beyond that.
What about the question that I asked you, Sandeep? Ranbaxy or a couple of these IT names?
Ranbaxy is clearly weak, Neeraj. I would sell into it even at the current levels, or a little bit of a bounce back to 410 or so. I see levels of 360, 365. HCL Tech is a little weak in the IT space. I think some profit booking is due even in that space. Though I would agree that the IT space is not as weak as some of the other stocks. But at this level, I don't think they can move up on their own and sustain.
Rashesh, what have you made of the Midcap meltdown at this point of time? And what are you advising your clients? I mean, stay clear of names where there is high promoter pledge, for example. Is that an advice you're giving?
I think A is that, B is, we have always maintained that companies and promoters who are overstretched, because as I said, interest rates are still high, and I think we in India are seeing a lot of companies where the promoters and companies are asset rich but liquidity poor, and I think liquidity is still going to be key for the long-term sustainable growth of any company. So we are advising our clients to make sure that they are invested in good quality companies where managements are not overstretched, where there is enough liquidity, cash flow. See, I think the current keyword is coming back is free operating cash flow. I don't think investors any longer are looking only at profits. They are looking at what is a free operating cash flow in a company, whether it's an infra company, a real estate company, or a consumer or pharma. And that's why you see consumers and pharma, which have done very well, have the highest free operating cash flows amongst all the companies out there.
But one mid-cap stock that did very well today was Jet Airways. Now, there is a long talk of whether the deal will happen or not happen. Today we learned that they have inked an initial pact, and this may be a precursor to the deal happening. I mean, without getting into whether the stock can reach a 750 or an 800 or a 600, just wanting your perspective on what does this do for a Jet Airways stock, purely from the fact that Etihad may come in, and they may come in well by purchasing the stake at a higher price.
To the best of my knowledge, what's been inked really is a deal, not so much an equity deal as a deal, to do with specifically with the UK sector. Sort of a sale and lease back deal. But to get back to your question, I think any sort of an equity stake taken by one company and another is sort of is a long-term solution to a problem. It's not necessarily short-term. So if you're looking to make a quick buck in this market, then this is already discounted. I mean, they've already discounted the fact that Etihad is going to come in. It's going to take a stake in Jet, and So as far as the short-term sort of gains are concerned, I think the story is over. In the long term, I mean, certainly it is going to benefit Jet in more ways than one. But it's a difficult sector, and at the end of the day, ultimately investors make money in companies which actually make profit and, as Rashesh said earlier, generate cash flows. And that process is going to take a while in the sector that you're talking about, because clearly it's gone through a lot of churn. There is further competition coming in, as we saw from the announcement by AirAsia. So it's going to be a long drawn out story. Certainly it's a happy augury for Jet, but it's by no means a magic wand which is going to solve all problems overnight.
Fair point. Bharat, in which case would that be an assumption on my part to believe that you would probably even advise steering clear away from some of the infra/power names, because the stocks have been beaten out of shape. They probably will not generate enough cash flows or operating profit for the next 2-3 years. But the budget or the government may take some steps in the next few months to come. Could that give a bit of a fillip? Would that merit an investment case, or you would just stay away?
No, at this point in time, stay away perhaps. What we have to realize is, the budget will do what it will do. I think, we make too much of a hoo-ha in our country over the budget. We sort of assume that the government does no work for 364 days of the year, and, everything that it has to do, will happen on the day of the budget. I mean, that hopefully that is not the case. I think tomorrow the finance minister will give the market the numbers that it wants to hear. My feeling is that the forecast budget deficit, for the next financial year will be the 4.8% that we want to hear. And therefore, tomorrow's budget, I think, will be more about not reacting immediately, but going behind each of those numbers to see what assumptions lie behind those numbers. In terms of the investing strategy, like I said, from a few years ago where we were growing at 9% and when we had an inflation of 5%, today you're at a situation where inflation is 9% and you're growing at 5%. But clearly the trend is changing, and I do see it changing, but it's going to change slowly. So in terms of any strategy that anybody has, it has to be oriented towards this. When things have turned to such an extent, what are the kinds of stocks that you should be in? Clearly, you should be in stocks, of companies which are making money, which are generating positive cash flows, and where there is very little possibility of, shock news coming through. Which is why you will see the good companies are the companies that are being sought after. Expensive companies are becoming more expensive, and cheap companies are becoming more cheap as investors shun risk completely and move towards, well managed, and I underline the words well managed companies. And that is the strategy that one should continue to follow until there is reason to believe that, there is a strong economic turnaround, both domestically as well as internationally, that the liquidity situation continues to be benign, which again over the last week or so, there is reason to believe that there may be cause for concern on the global liquidity front as well, which is really what is propelling your markets. So, until there are grounds to believe that you're back to the old sort of bull